Hello, ladies and gentlemen. My name is Greg Michalowski from ForexLive.com. Today's date is October 16, 2014. Title of this report, words best describe it. I'm not going to show you a single graph. I'm not going to show you a single price. I'm just going to talk to you. I'm going to talk to you about the market in trading here today and how I think about trading days like today. Today was not a normal trading day. It was an abnormal trading day. You can look at the ranges today. The euro had a 264 pip trading range. The pound sterling had a 200 pip trading range. The dollar yen had a 231 pip trading range. The sterling yen had a 313 pip trading range, and the sterling versus New Zealand had a 392 pip trading range. These are not normal trading ranges, even in the best of times when the market was more quote-unquote volatile. So we had an abnormal type of day as far as the ranges go. We also had an abnormal type of day in other markets. And when we look at the stock market went down about 460 points, came back in the United States, closed down 173. We also saw other stock markets around the globe lose a lot of value. Giving you an idea, the Euro stock index lost 3.61% today. The German DAX index lost 2.87. The French CAC lost 3.63. And we're applauding at just a 1% decline in the Dow Jones Industrial Average at the close here today. It's still a 1% decline, and we are down much more than that at its lows, but we're not necessarily, I wouldn't necessarily call it a normal type of day. We saw the bond yields in the United States move from 2.20 down to below 2% in trading here today. We saw German bond yields move down to around 0.7%. We saw French yields move down to 1.07%, and UK yields come down, and we saw Greek bond yields move up 85 basis points before the market opened here to trading here today. Those are not normal type of moves in the debt markets as well. We saw oil prices move around. We saw gold prices move around. We had the Ebola news come out, and the Ebola situation is something, honestly, that a lot of times I think news hypes things to the point where they're creating this unnecessary fear. But this is one of those things where, it's kind of got me a little bit concerned. Why? Because typically, if you have fear, you try to define your risk and limit your risk and go forward with it and then accept it. And if you can do that, then your fear should disappear, okay? In this case, when hospital workers who worked on an Ebola patient contract Ebola, when they're in an environment where the risk is defined and the risk is limited, presumably by the precautions that they're taking, and yet they still contract this disease, and then they go off and they get on a plane, and they may rub their eyes, they may touch a ticket that has, whatever they rub their eyes off on, and someone else gets it and goes and kisses their child and whatever, and you have this multiplier effect that could take place. And so risk in the Ebola situation, when this happens, is not being defined and limited, okay? It's spread outside of the environment that I thought it would stay. And that can be a problem. And so that is an abnormal situation that we have to deal with today, and we're going to have to deal with going forward as well. If 10 people on that plane end up getting Ebola because I don't know, whatever, or 10 people that she had contact with, from airport people to people who handled her baggage because she rubbed her eyes and she put it on in the bacteria state. I don't know, I don't know. But that's going to be an issue, and it's going to cause some problems in the market. So these are abnormal situations. Now, and then in the foreign exchange market, we had the movements in the market in and of itself that caused a problem. And I took time out and I wrote a little piece that was titled "Markets Are Not Normal, Trade Accordingly." And the first couple of sentences I said this: trading is not normal, risk is increased. If risk is increased, positions should be smaller than normal. This is not time to be a hero. Now let me talk a little bit about risk first, and then I'll talk about what you should do when risk is increased like it was, and we had this abnormal market. when I talk about risk, we know about market risk. Market risk is when the market moves up and down. Every second of every day that the market is open, we experience market risk. That the next pip is going to be up, that the next pip is going to be down and up and down and up and down. That is market risk that we accept, and we try to control by using technical tools, or that's how I do it, okay? And that's market risk, and we all know about this. Now we have event risk, okay? Event risk is like economic data that comes out. It could also be a tsunami. It could be Ebola. It could be the stock market moving 400 pips. That is their market risk, but it's not the Forex market's risk. It's an outside event that's causing the Forex market to move. Okay, so I consider that event, the stock market, to be an event happening that's happening continuously. And if it moves, abnormally, then we get this abnormal event that occurs. Okay, and we affect the stock market as well. So it goes back and forth. So that's event risk. And event risk sometimes is control, because we know that the data is going to come out at 8:30, and once the event risk is over, that we know about it, and it's over, it disappears. Okay, and we go on our merry way, and we go on our merry way and just return back to evaluating the market risk. But that wasn't the case today. We had the Ebola situation. We had the other markets moving around in very volatile fashion that increased the event risk caused by that. And so we had this continuous stream of event risk that made our risk much higher. Okay, risk is increased. And then the third type of risk is liquidity risk. And liquidity risk occurs when event risk is typically high. So when we have stock market moving down 400 points, or moving down 300, then coming back to near unchanged, and then moving back to minus 300, that causes liquidity risk in the markets. And so we had market risk, we had event risk, and we had liquidity risk, and we had it for a lot of or at least a portion of the day. And so when risk is increased like that, that's when you start to recognize and start to say, okay, what do I do? What do I do as a trader? And I mentioned in my post that positions should be smaller than normal. That's one thing that you can do. So if you're going to trade with smaller positions. Now, you also have another choice, and that is not to trade. We don't have to trade. Our goal is to make the most amount of money with the least amount of risk. If the risk is way up here, and that's beyond your risk tolerance, then don't trade. Or if you're going to trade, just trade a smaller amount, because risk is way up here. All right, so again, our goal is to make the most amount of money with the least amount of risk. It doesn't mean don't take risk, but it doesn't mean go out and take excessive risk. Control your risk, and you have a choice to do that. Don't be a hero. I likened it to the idea that you're driving along in a snowstorm. If you're driving along in a snowstorm, you're going to get to your destination probably at a later time, okay? You're going to be more cautious, or most people are going to be more cautious when they drive along in a snowstorm. These are governors that you put on your driving, because the risks are increased. Now, taking it to trading, if you're in a snowstorm caused by Ebola, caused by the stock market moving 400 points, caused by bond yields moving down, causing by Greek bond yields moving up large, caused by economic data that comes out. If you're in a driving snowstorm in the Forex market, does it make sense to be left lane hammered down and zipping along in the fast lane, moving along at the regular clip? You may get there faster. You may get lucky, in other words, and get to your destination faster than the guy who's being more cautious in his trading, who's maybe even pulled over the side of the road and not trading at all. But you may also have that blow up. You may end up in the median of the highway with the car in the ditch, waiting around for a tow truck, and you don't get there fast enough. In fact, you never get there. You blow up your account. All right? So that's the equivalent thought process for abnormal markets. Driving in a snowstorm. We have a choice as a traders, folks. We can go hammer down all the time, especially in abnormal markets, and try to make make a ton of money. And we can actually make the most amount of money with the most amount of risk. But we can also have the opportunity to lose the most amount of money with the most amount of risk. And those are the types of markets that I want to stay away from. I want to drive more slowly, more cautiously, with lower risk. I want to make sure that I'm in firm control at all times, and that I get to my destination safely, and that I'm going to be able to trade again tomorrow. And that, my friends, is a lesson here today. So words best describe it. The charts, let's leave them out today. Take heed in understanding what your risks are, whether it's market risk, liquidity risk, event risk, and understand what that means to your trading. And if you do, you're going to be around tomorrow and the next day and the next day. My name is Greg Michalowski. Good fortune with your trading, folks. Bye-bye now.